Hi, I'm Paul Bechtold, RVP and manager of our Debt Elimination Programs here at Gordon Marketing. And today I have Ray Parman, life insurance manager for Gordon Marketing. And we want to talk to you today about 3 steps, 3 rules to help make an IUL successful.
Yes, sir. How's it going, Paul?
Good, good.
Yeah. Just wanted to talk about the importance of structuring an IUL in a proper manner, and also managing the client's expectations through the sales process, and even after post sale, after the sales process there too.
So Ray, you and I obviously we travel parallel paths. You more on the IUL side, me more on the whole life side. But I can't emphasize enough the importance of what you're talking about, because it's proper fit and function, not so much the product, would you say, that's going to determine the success for the client.
Yeah, absolutely. And, we all know accumulation-focused IUL, or even whole life structured that way, it comes with a lot of features and benefits that are obviously going to benefit the client in the form of course, the death benefit, but the tax-free distribution potential too with an IUL. And, we see a lot of cases, and I'm sure folks tuning in out there see a lot of cases where maybe somebody over-illustrated a VUL or even an IUL, and perhaps the client didn't stick to the plan, or maybe they were just trained up to just pay the minimum premium to keep the IUL limping along. Next thing we know, they're getting in their 60s and 70s, and we see them getting way upside down, and the IUL or VUL imploding on them.
Right. So Ray, as the title suggests, why don't we talk about the 3 most important variables and fundamental cornerstones that an agent might focus on in properly designing that IUL.
Yeah. So there's 3 that I abide by, and I think it's just really important to make sure that it's designed the right way from day one. And if we're looking for an accumulation play where we want to ratchet up the cash value growth, we have to solve for that minimum non-MEC death benefit. We want to keep it still tax efficient, but we don't want the cost of insurance to supersede and take over this money that we're paying into it. We want a majority of it going towards growing the cash value.
So the first thing I'm hearing you say is proper structure. We have option A, which is level death benefit, correct? Yep. And we have option B, which is increasing death benefit.
Correct. Yeah.
And the majority of the cases that we do, both in your world and mine, are increasing death benefit cases, right? We want that minimum amount of death benefit, maximum cash accumulation, because most time we're talking about a long-term wealth building play. Is that correct?
Absolutely. And so, imagine this, the death benefit sits on top, and every time we stuff a little bit of more premium into it, it goes in, and the death benefit goes up just high enough to still, hit the definition of what a life insurance contract is, keep that tax efficient, method there, not have a modified endowment contract situation. But, the second one there too, at the end of the day, Paul, it's just the client has to be able to stick to the plan. It has to be something that they can afford, and even if times get tough, would still have the means to keep the policy going. I think that's yet another, the second part of what needs to be in play there is just knowing the client and knowing what's realistic for them to contribute to a plan like this and what's not.
So what I'm hearing you say on the second front is the commitment to the strategy.
Absolutely.
Right? Okay. And here's another thing that I think a lot of agents don't know. Tell me if you agree. If we do have to get off track, which we hope they never have to do, right? But one of the beauties of cash value life insurance is at the point that they want to go back and catch up. Let's just say they change jobs and get a signing bonus. Let's just say they get a big tax refund back. Let's just they say they have some place that they want to store cash, and the first place they should go to is that policy that's been underfunded, because why? They could call the insurance company up, and the insurance company will tell them to the penny exactly how much room they have to catch that up and get right back on track.
Absolutely.
And unlike a qualified plan, where if we miss our year of contribution, we're done until we're 50, where we get a $1,000 per year catch up, right?
Yeah, that's very true. And that's the beauty of cash value life insurance. There is that flexibility now. That's beautiful. It can be a double-edged sword, though, as we know, because if somebody gets into the habit of taking too much time off from repaying or paying premiums, or chooses not to pay back a loan or something, that's where years down the road we find ourselves with clients that get upside down in their policy.
So what I'm hearing, it's kind of like going to college and maybe going to the gym. Once you take a little time off, it's hard to get back on the track.
It kind of is. Yeah. I mean, as are much things in our lives and stuff there too. But yeah, and last but not least, especially as it pertains to IUL, we have to be mindful of how we illustrate the assumed rate. So, we can, there's AG 49 out there, which are guidelines and actually regulations by the industry to kind of keep all the carriers in check and make sure that somebody isn't over illustrating a 10 or 12% rate of return, when in actuality, these IULs are going to be anywhere from 5 to 8%, generally speaking. So just being mindful of that at the end of the day is going to help manage your clients' expectations as they continue to contribute premium to this plan, and so that the outcome can at least be a little bit more manageable there.
Right. So, we definitely want to underpromise and overdeliver. We don't want to have a situation where an agent's E&O comes into play.
Exactly.
And a client can say, hey, you promised me things that were never going to happen or were unrealistic to happen, right? And I would agree. I think that the carriers are helping us play in that game more now. The NAIC regulations and so forth are not allowing us to make unrealistic illustration assumptions and so forth, and help them to stay within safe margins.
Yeah, absolutely. And then just if you don't mind, before we finish this up, Paul, I just want to make mention of one more thing, and I think this is very, very important. And I guess you could almost consider this a fourth important feature that you want to have on an accumulation-focused IUL is overloan protection. Most IULs come with an overloan protection rider, so that's basically a safety net for years and years down the road. When your client goes to take a distribution from the policy, they're not going to be allowed to take too much out and actually end up lapsing the policy.
So again, operating within safety margin as well. Ray, this has been very helpful information today. I'm sure our agents out there have lots of interest in the IUL space couldn't get a hold of you. How can they best accomplish that, Ray?
Yeah. Just shoot me an email. It's ray@gordonmarketing.com, or you can call me here at the office. I'm at extension 107.
Great. Well, unfortunately, folks, our time's come to a close today. Be sure to click the notification bell at the bottom of the screen so that you can be appraised of when other episodes of Selling Life and Annuity are coming along. And with that, like, comment, and share these videos to people you know could benefit from them. But for now, along with Ray Parman, I'm Paul Bechtold, and we wish you happy selling.